Hello, everybody, and welcome to our 2023 CPD series. For those of you who are joining us for the first time, the CPD series is a string of different masterclass episodes that you can watch over the next couple of weeks, all of them on topics that we think are very pressing and very interesting to the financial services sector. This is the third year that we are offering our CPD series, and we try each year to pick topics that we think are perhaps opportunities for some thought leadership or opportunities for us to delve deeper into issues of importance. These episodes in the series are all accredited for CPD, Continuous Professional Development. And those of you who are joining us in order to get a CPD hour, you will be able to get a certificate after attending this masterclass today. Please just remember though that you need to stay online for the full hour because we do verify your attendance before issuing that certificate. I haven't introduced myself yet. My name is Jessica Blumenthal. I'm a director in the Banking and Finance Department of ENS Africa based in Cape Town. Throughout this series, you'll meet several of my colleagues spread across the firm in different practice areas and often in different offices around Africa. And we are all working together as part of ENS Africa's ESG practice group. The practice group is multidisciplinary and also multi-jurisdictional. And that's because we believe that ESG can't be a siloed discipline or a single discipline's concern. It's something that affects all of our practice areas and all of our jurisdictions. And we need to work together to be able to ensure that we can offer our clients the diversity of thinking that's required to really tackle these emerging issues under this banner. We have asked all of you attending today to send us questions beforehand. So if you have sent us questions through, we'll have worked those into the presentation. You are able to ask us questions as we go, and you'll see at the bottom of your screen there's a Q&A block where you can load your questions. If we aren't able to deal with any questions during the presentation because of time constraints, then we'll make sure to get back to you afterwards and address your question. Please do not post as anonymous because that of course makes it very difficult for us to do so. So those are all the housekeeping points. If you haven't seen the list of webinars or masterclasses coming up, remember we start today as the first one. There are about 15 installments and we're running through April and right up till the end of May. So please do have a look at the list, and if you're interested in joining us, please do RSVP and register for the other masterclasses in the series where you'll get an opportunity to meet, as I said, some of the other colleagues working in the ESG practice group. But let me kick off with today. So I'd like to introduce you to two of my colleagues who work with me in banking and finance, also with a focus on financial services regulatory, and that is Alex Taylor, who's also a director in the Banking and Finance Department, and Talia Cullinan, an associate who works closely with us. And the topic today is really focused on financial advisors in the advisory industry and what the role is of the advisory industry in helping financial customers to navigate the complex and often noisy and confusing world of ESG investing. So we hope that you enjoy the session and that you take away some further thinking from it. And again, please do reach out to us if you'd like to discuss any of this further. I'm going to share my screen. Give me 1 minute. Hopefully you won't have any technical issues. Go. Okay, there we go. Hopefully the presentation is on the screen and everybody can see it clearly. All right, so as I said, today we are going to have a look at what ESG means, what ESG investing means. Think about that from a consumer or financial customer's perspective. What does it mean to customers and how they make decisions around where they place their hard-earned savings and investments. We'll look a little bit at how this interacts with financial products that are available to financial customers. And then we will really look at the heroes of the moment, or the financial advisors, the advisory industry, financial services providers, and look at what ESG investing means for them as they attempt to bridge the gap between financial customers and the financial products available to those customers. Talia will take us through the duties imposed currently by South African laws on financial service providers providing financial advice in this regard, and we'll look at what the current standard is. And then we'll look to international jurisdictions, because as we know, particularly in the ESG space, and of course in the consumer protection space from a financial sector perspective, South Africa is often guided by the European and the European example and developments in the United Kingdom. And so Alex, Talia, and I will talk you through those developments as well, as a way of considering where we could be going in the future, and obviously discussing and thinking about what that means for financial advisors and what they can do to prepare for regulatory development that may be on the horizon. So that's our agenda for today. So let's start really at the beginning. What does ESG mean for investing? And it's a difficult topic because ESG is really just an umbrella term, coined for the first time in 2004, so not a new term at all, but an umbrella term for environmental, social, and governance factors. And unfortunately, because there's not much clarity and because it is such an umbrella term, many different things can be pushed in under that heading. And so when we talk about ESG or ESG investing, it can become, particularly from a consumer's perspective, very confusing. And there's a lot of blurriness and gray where it is difficult to determine whether it is really something relevant to an investor seeking financial performance for their investments or not. ESG investing, sometimes when people say it, they mean socially responsible investing, they may mean impact investing, they may mean sustainable investing. They may mean that they want to prioritize optimal ESG factors or outcomes. They want to ensure that their capital delivers those outcomes and is used to deliver those outcomes in the real world economy. They can mean that they want to be conscious consumers, or they may just be investors looking to ensure that there's proper risk mitigation with long-term consideration of factors which could affect the financial performance of an asset, and that there's opportunity optimization by an asset manager or a financial product house in looking for opportunities that will arise as the real economies of the world evolve in this rapidly changing space. So ESG investing can mean very many different things. And again, this makes it complex for advisors seeking to deal with customers who come sometimes having heard something in the press, having received a tip from someone else, or who really want to quite consciously ensure that their capital is allocated in a meaningful and conscious way. Not all of those people mean the same thing when they talk about ESG investing. And that's why it's very important for advisors to be able to cut through the noise and to steer consumers correctly. For purposes of this presentation, I think it's easiest to divide consumers or financial customers into two groups. There is a group of an emerging group and perhaps rapidly growing group of financial customers who want to allocate their capital or align their capital allocation in accordance with their values. So they want to be sure that their money is invested into companies that are generating real world change. For example, focusing on decarbonization in order to ensure that we can reach the Paris Agreement goals that have been set around decarbonization. But there's another group of investors who aren't so interested in aligning their capital with such kind of impact, but rather they are concerned that if one looks at the long-term sustainability of investments, it is critical that environmental, social, and governance factors are taken into account in investment decisions, and that if this is not done, there is a real risk of financial loss as the world rapidly changes and evolves. And the point here, and I think something that the second group of financial customers is perhaps very aware of, is that as we enter this new evolving space, change happens at a really quick pace. And as regulatory changes happen around the globe, this can have an almost unforeseen impact if one is not being very reactive and very mindful of these factors. It would be disastrous, of course, to be caught flat-footed and invested in an industry or a sector which suddenly, through disincentives or regulatory changes, is no longer able to carry on business in the way that it had planned to do so. So ESG factors and the consideration of these environmental, social, and governance factors in the investment decision-making process is critical in ensuring long-term financial performance of savings and investments made by consumers. So, as I've said, increasingly there's a group of clients that want to align their investments with their values, but there is also this group of clients that is concerned about the long-term sustainability and financial performance of their investments. And the two groups, of course, often overlap and are not necessarily two separate groups, but it's useful to think of them in that way. There's some examples on the screen of ESG issues that could influence or affect investors and the investments that they make. And that's just really to give you an idea of how broad this ESG umbrella term is and how many different considerations it brings into the investment making decision. And many of these factors are not new. They're factors that prudent asset managers and prudent product houses would always have considered in allocating capital. Something like governance has for a long time been a consideration that has been taken into account in allocating capital. So there's not necessarily new factors, but it's really the weighting of these factors against financial performance that is where this change is coming about. So from a product perspective, this is now from the perspective of the product house developing either an ESG fund or an ESG index tracking fund, or a collective investment scheme targeting a specific ESG strategy. That is really where that's the generation of the product, and that is perhaps the start in this inquiry. And there, I think already around the world, and particularly in South Africa, we've seen a lot of change and a lot of effort being made to ensure that there is ESG integration. Many of the players within the financial sector in South Africa and of course globally are already signatories to the principles of responsible investing. And you'll see those principles in the block on your screen. Those principles require asset managers and asset owners to incorporate ESG issues into the investment analysis and decision-making process. It requires them to act, or they undertake at least by signing up to the principles, to be active owners and to incorporate ESG issues into their ownership policies and practices, to seek appropriate disclosures on ESG issues from investees. And of course, disclosures are important in order to ensure that ESG metrics or data relating to these issues is available to help either drive capital allocation further into such companies, or of course to drive disinvestment, and to work together to promote acceptance and implementation of these principles within the industry, and to enhance the effectiveness of implementing these principles across the industry, and then to report on activities and progress. So those have been the principles of responsible investing, and they apply to those who've signed up to them. And in South Africa, we know many players in the financial sector have signed up. And that translates into strategies being adopted in order to give effect to those principles. Historically, we saw negative screening as the main way of ensuring that a particular portfolio took account of ESG factors. But as there's been a rise in ESG funds and funds following ESG strategies, there's been development in this space. There's now a move towards positive screening, where there is a focus on funds that are meeting companies that are meeting ESG metrics and hitting certain key performance indicators or hitting certain targets, sustainability targets set. There is different percentage allocations to those who meet targets and those who don't. And there are different ways, different strategies that can be adopted in building portfolios like that in order to ensure that the principles are met. But taking it back to the advice industry's perspective and the consumer's perspective, all of that relates to the product that's being built that is then available for advisors to use when advising their clients as to how to invest, and that are obviously available for clients or customers to invest in. But it's the ability to understand those products and to convey the positives and negatives around those types of products to a customer that becomes so important. Because, as I've said, whilst the principles are perhaps self-explanatory, there are different strategies to meet the principles, and not all of the products are the same. So this graph really just shows, again, and underlies the point that there has been dramatic growth in this area. So you'll see here the orange line showing you the growth in the number of signatories to the principles of responsible investment, and those principles affecting very many more assets under management than in previous years. We've also seen globally the growth in sustainable fund assets. And of course, this has been met with criticism because cynically, the argument is made that these fund assets have, or these products, perhaps skip to the next slide, but products such as sustainable funds have been launched to meet this growing demand. And oftentimes, and that has led to, just jumping back, that has led to this large number of assets coming under management, flowing into ESG funds or sustainable funds. But oftentimes, those funds have not really been as green, in inverted commas, as consumers may have thought them to be. And so in recent times, we've seen a bit of a self-correction or a backlash against ESG funds and ESG investing as a heading again. Again, we're using broad terms to describe quite complex, nuanced problems, but there has been a backlash, and we've seen development in Europe and in the US around regulators trying to get more granularity around what asset managers mean and what funds mean when they say they are sustainable or they are green. In Europe, we have seen the SFDR, the Sustainable Finance Directive on Reporting, which provides a framework against which funds can categorize themselves as to how, that when they say they've integrated ESG into their investment making criteria, what that really means, and whether their portfolios really are invested in companies that are meeting ESG metrics or whether they're falling short. A lot of this criticism has come from the fact that this is an emerging space. And so sometimes when a fund is naming itself or labeling itself as an ESG fund, in fact, the underlying investments are not perhaps worthy of that label. And we've seen a similar issue with index providers as well. So there has been a backlash in both the UK, the US, and the European Union. And there's been a call for more consistency around labeling and around terms, so that when we talk about a fund being an ESG fund or a sustainable fund, a consumer is able to identify, a consumer or a consumer's advisor is able to identify what that means and thereby compare apples with apples. It's very important to be able to compare apples with apples because a lot of these products do come at a higher cost to a consumer. And so if one is going to pay a higher cost for a higher level of due diligence on underlying investments, then as a consumer, you need the certainty that you are in fact getting that. In the US as well, we've seen a kickback against ESG investing. You will have seen all of the headlines. It's become a political issue around where capital can be invested. And so the reason perhaps for that is that there is a lot at stake. Assets under management represented by retirement funds and discretionary savings or discretionary investments of savers, that represents a large capital block that can either be allocated in such a way that it makes an impact in the real world, or it could be misallocated into funds that are labeled as being ESG funds or green and inverted funds, but are in fact not having the real world impact that the capital should be having. So it's an incredibly difficult space for a consumer to navigate, an incredibly noisy space with many different side issues, distracting consumers and perhaps making it hard to make a simple investment decision. And that is really where our thinking comes, that it is the advisor's role to help the consumer to navigate this and to ensure that when they place the investment that they wish to place, they do so with a full knowledge of the complexity of the issues and also an understanding of the product that they are in fact investing into. And at this point, I'm going to hand over to Talia to take us through what the current position is in South Africa and to look at what ESG means for the financial services providers, the providers of advice to financial customers against this backdrop.
Thanks, Jess. Right, so much of what is on the slide has been covered by Jess, but just to emphasize the role of which the financial services provider plays is essentially the link between the product, as which Jess discussed earlier, and the clients. Unfortunately, or with having this type of role, there's an obligation to play the link, but with that obligation also creates or may create an obstacle for clients to be able to reach the desired investment or to make the correct investment. Naturally, of course, there are some concerns that FSPs may have relating to ESG investments, which we've placed on the slide. These include greenwashing or impact washing of funds and financial products. So greenwashing is where a company claims that the business practices or products are sustainable when in fact they aren't. And similar to greenwashing, impact washing is when fund managers or bond issuers overstate or falsely claim an investment's positive impact. A second concern could be that, that FSPs may view that ESG investments may be sacrificial because the returns are lower and slower, which would or could be the case with a short-term investments, but not necessarily with your long-term investments. As raised by Jess a few minutes ago, ESG could also be a more expensive investment style, as ESG investments may include higher fees or premiums, which I've recently read as being called greeniums, which is quite funny. And these are often higher than traditional funds. And the reason for this is mostly because it is likely that ESG products have to be actively managed. Another reason or concern is, of course, the conflict of interest, in that FSPs don't necessarily believe in the ESG investments. And this also links to the fact that an FSP may not necessarily have the skill or knowledge or understanding that is required to actively or appropriately advise on ESG investments. But concerns aside, there are of course some comforts that surround making ESG or giving ESG related advice, and these include keeping the client's best interest into account, or taking into account that the ESG investment is personalized. It addresses clients' demands and clients' priorities. This could also avoid any blow-ups related to risky investments in some of those dodgy companies or operations and their products. And what's also a great comfort is that there's been an increase in performance tracking of ESG products, so that ESG or FSPs who are making ESG or providing ESG advice are able to give such advice, with the comfort of the product actually being properly tracked. Jace, we can move over to our next slide, which actually sets out the existing laws in South Africa. So there isn't an explicit law which imposes a mandatory duty on FSPs and their representatives to take ESG factors into account when advising their clients. However, we can argue that the existing duties and responsibilities in our legislation as it stands today does incorporate this duty to consider ESG factors when advising clients. So we've listed on the screen the General Code of Conduct and Fit and Proper requirements, which all relate to, the duty to take into account this, the interests of the clients with due skill, care, and diligence, to avoid conflict of interest between the provider and the client. So regardless of how the provider may feel, it is still their duty, specific duty, in fact, to give suitable or appropriate advice, which we'll talk to on the next slide, and also to render your services in accordance with the reasonable requests of client instructions, whilst having due regard to their interests, which interest must of course be accorded appropriately over any interests of the provider. So, I mean, we're not saying that FSPs don't do this, but it should be that FSPs must be able to set their own views and interests aside, and to be able to look at the product and the needs of the clients, you know, with the view of giving them their best, or keeping their best interests at heart. The fit and proper requirements also state that it's a responsibility of a financial service provider to ensure that their key individuals and representatives are able to assess the product or financial services provided, taking into account the needs, circumstances, risk tolerance, and capacity of the client itself. So this is quite a broad duty. And sorry, Jess, if we just move over to the next slide, thanks. And this brings us to the suitability of your advice that you will be furnishing to the client. And I think this, or our view, is that this is essentially where the ESG, the duty to take ESG factors into account actually lies, is to be able to give suitable advice. And what it means to be suitable is that it is appropriate to the needs of the clients. So we've listed all, basically set out Section 8 of the General Code of Conduct, which sets out what it is to give appropriate financial products or services. Interestingly, though, you'll see there that it says an FSP must be able to conduct an analysis for the purpose of advice based on the information obtained from the client. And as such, the FSP may take into account any specific objectives, needs that the client may have, and basically any specific objectives or needs the client has set out or requested or agreed to. And although it says may, and it's not a must, it's not an obligation, we still think that in order to give appropriate advice and to ensure that it is suitable, one would have to look at the ESG nature of the investment, especially when it comes to long-term investments, because as Alex will look at or discuss briefly later with regards to Regulation 28, there is ESG factors will have an impact on the long-term sustainability of the product and that the client will essentially be investing in, and to not have regard to that, it would rather be inappropriate. Moving over to the COFI side, which of course one needs to look at when discussing any financial sector laws. So COFI is still a bill. We're hoping to see that it will become an act sometime this year. And essentially the importance of COFI is it carries through the principles that we have, that is currently set out in the financial services provider sphere, and will carry these principles over to all financial institutions because it will apply to all financial institutions, and the definition thereof is rather broad. So if a licensed financial institution, similar to existing FSPs, must also conduct their business with integrity, due skill, care, and diligence. They must identify and promote the corporate culture that considers the ethics of themselves and that of the services that they are providing. They must ensure fair treatment of their customers, avoid any conflicts of interest, and importantly, they must ensure that any disclosures that is published by third parties will comply with all the requirements set out in the COFI Act, essentially, when it becomes an act. These requirements, so essentially what that means is that the responsibility of an FSP will remain throughout the advertising and product lifestyle, and the responsibility of that will remain with the FSP. And so the FSP must ensure that its advertising houses or third-party service providers that it employs, when making certain disclosures of their products, are appropriate and suitable. Thanks, Jess, for moving over. And this also brings us to, the principles relating to the financial products and financial services. So where the previous slide spoke to the obligations of the financial institution, here the principles specifically look at the financial service and the products provided. So again, the same principle with existing FSPs, the product or financial services must be appropriate to targeted financial customers. It must be provided in an objective manner. The products must perform as they have been led to expect. have led the clients to expect that they will perform. And if they are unsuitable, the FSP must take remedial action to ensure that the clients are not in any harm or exposed to any risk. Similarly, the financial institution must also employ oversight arrangements to ensure that your product and your services are on an ongoing basis suitable to your clients, and they must be able to monitor the products and services in this as such. The operational ability will also include oversight arrangements related to representative other financial institutions and service providers who've undertaken to distribute and sell your financial products and services to financial clients. So that is essentially the existing laws that we have now and those upcoming under the COFI bill. Alex, I think we'll move over to you to discuss the next part. Thank you.
Thanks very much, Talia. Yes, so as Talia alluded to, we're going to pause for a moment to take a look at the pension fund industry and what's going on there with regard to ESG. And this is obviously very important for financial service providers and advisors because pension funds make up the majority, or a very large portion at least, of the institutional investor capital that is deployed into the financial services investment market. So as early as 2011, Regulation 28 of the regulations published under the Pension Funds Act, which you all know deals with the asset classes and asset spreads in which pension funds may invest, was amended as you see on the screen, which essentially requires funds to adopt socially responsible investment approaches that promote and consider factors that affect long-term performance. And if you look on the screen, you'll see that it's actually a fund's fiduciary duty to act in the best interest of its members, for whose benefits depend on the responsible management of fund assets. This duty supports the adoption of responsible investment approaches to deploying capital into markets that will earn adequate risk-adjusted returns suitable for the fund's specific member profile, liquidity needs, and liabilities. And then it goes on to say that prudent investing should give appropriate consideration to any factor which may materially affect the sustainable long-term performance of the fund's assets. And there you have it in black and white, including factors of an environmental, social, and governance character. And so here we see as far back as 2011, the pension fund industry recognizing that environmental, social, and governance factors not only play a sort of social and moral role in investing for the good of all of us, but actually affect the bottom line and the ability of funds to continue to be profitable into the future. And thus it goes to the fiduciary duty of pension funds to ensure that these factors are appropriately addressed in the underlying investments in which fund capital is deployed. So we can move over to the next slide, which moves on to an interesting sort of new development in the South African context. So in September of last year, the Code for Responsible Investing in South Africa, Code 2, affectionately known as CRESA, was published. And this code is endorsed by, amongst others, ASISA, BATSETA, the FSCA, the GEPF. So there's been a lot of market uptake of this code. And essentially the goal of this code is to reaffirm a framework of principles for stewardship and responsible investment as a key component of the South African governance framework. The code has got 5 core principles that should be taken into account towards achieving this goal. And indeed, the very first principle on the list is ESG integration, which involves a systematic approach of integrating material ESG factors into investment decisions. And the code contains a useful list of recommended practices to achieve this goal in the principle of ESG integration, including developing ESG strategies and policies, identifying and addressing risks, and enhanced reporting mechanics. So the outcome that is intended
is to support a more inclusive society and economy along all ESG pillars, such as a just transition towards a greener and more inclusive economy that enables sustainable development, protects livelihoods, and supports the availability and equality of opportunities to access financial services and products. Now, while these are not sort of black and white rules that and they're not mandatory to comply with, this is a great indication of the best practice of policies and sort of procedures that we could start taking into account in order to achieve the broader goal of ESG integration going forward. And then moving on to my next slide, please.
Alex, sorry, just before we move on to talk about the international example, if I can just add one further thing here, perhaps just to summarize where we've got to so far in the presentation. Essentially, what we can see if we look at things like CRESA or even the requirement in Regulation 28, which, as Alex has said, has been there for some time, the fact that we have an uptick in the number of signatories to the principles of responsible investing. What we can see from all of that is that the available financial products in the investment universe, there is a rapid move, and there have been over the last couple of years many developments in that regard for those products to become more ESG centered. So whether it's in order to be something that could be categorized correctly as an ESG fund, or whether it's a traditional fund or an ordinary fund that has merely just taken into account, as is required of a prudent manager of capital, all of the factors that could affect the long-term performance of that fund. And that second part is the mainstreaming of ESG factors. The fact that prudent managers will take those factors into account in managing the money that has been bestowed upon them. So when we look at that as that's the investment universe that's available to consumers, then we look at consumers on the other end of the spectrum who are trying to make a decision between where to place their retirement savings, for example, between retirement fund A and retirement fund B. Previously, an advisor fulfilling all the duties that Talia described around acting with due care and skill and giving appropriate advice with reference to the needs of the financial customer, that advisor would essentially analyze the risk appetite of the customer. They would ensure that the customer understood the product that the customer was investing into, understood the fees and expenses related to that product, and against those criteria, assist the customer to invest in the most appropriate product for the customer. What we're suggesting is that, in fact, the job of the advisor as the so-called missing link, as we've been referring them to, goes one step further. And it may be the role of the advisor to help the customer to understand whether retirement fund A or retirement fund B, for example, is really integrating ESG factors successfully into decision-making processes. And the reason for that is the point that Alex brought across in the Reg 28 discussion, is that if we accept, as our legislature has done in amending Regulation 28, that ESG factors can have a financial impact on, particularly over the long term, on an asset, then it is important from a consumer's perspective to ensure that will, for at least for them to have comfort that the products that they've invested in, or the asset managers to whom they've given their money, are taking all these factors into account and therefore protecting them against the risk of financial loss in the long term. And it's an exaggerated risk because as the real world economies evolve, as I said at the beginning of this presentation, they're not evolving in a normal timeline as we would expect economies to evolve where there are technological developments or other regulatory developments. Because of the focus and the need for a quantum leap in change to address, for example, climate change is just one of the environmental objectives that we as a global community need to address. That's causing regulation to be fast-tracked, incentives to be provided where previously there may not have been a policy expectation of an incentive to be provided. And this requires active management and active adjustments to portfolios to ensure that a consumer's investment, whether it be in their retirement savings or in some other discretionary pooled product, that the consumer's investments are not at risk. in the long term. And that's really just to add that before we move across now to look at the international example, that's essentially why it's important for advisors to be able to address these issues and this complexity with their clients, financial customers. Thanks, Alex. Back to you.
Thanks very much, Jess. So on that note, we are going to pause for a moment to have a look at what's going on in some of the other jurisdictions. So just, there we are. So an interesting development as of October last year is that the Financial Conduct Authority in the UK brought out a consultation paper on sustainability disclosure requirements and investment labels. And this document essentially contains proposed measures to combat greenwashing, which we discussed earlier as the practice of making exaggerated or misleading sustainability or green claims about investment products, which then has the effect of eroding customers' trust in the market of green or sustainability related products. And it's quite a lengthy document, but one of the key flavors that we took that was quite interesting from the document is that they introduced 3 labels for green or sustainability related products. So we have the first label is products that have a sustainable focus, and these are essentially investments in assets that are environmentally and socially sustainable. And the second label is sustainable improvers, which is an investment that improves the environmental and or social sustainability of assets over time, including in response to the stewardship influence of the firm. So these are our investments that actively improve. And then there's the sustainable impact type investments, which are in solutions to environmental or social problems, so that actually achieve a real world impact in their sort of focus. So these labels, together with disclosure requirements, aim to address this concern of greenwashing that has been eroding customer trust that we just spoke about, and thereby build trust and integrity in ESG labeled products and sort of create some uniformity and some, give some principles that can be relied upon by the market and by advisors when assessing different types of products, and to give consumers the information that they need to make informed choices, and consumers there as well, their advisors, about products which meet their preferences and their needs, and also to describe the different profiles of assets more accurately. And then naturally, there would need to be reporting and assessment in order to ensure that product houses are only using these labels if they actually qualify with the criteria and are able to substantiate the claims that they are making in order to place one of these labels on their product. So if you just go back, Tyler's going to take the slide, Jess. So just in conclusion there, that's quite a neat proposed solution, we would think, for trying to make sense of, as Jess was saying earlier, all the noise in the market about who's doing what and how do their products compare. So perhaps this is something that the South African market can learn from, and something that we can start doing as well in the future, sort of standardizing the labeling of products going forward. And with that, I'll hand over to Talia to address the next slide. Thanks, Jess.
Thanks, Alex. Right, so the Financial Conduct Authority in the UK didn't stop there. They also, in July 2022, so last year, published together with a policy statement, the final non-handbook guidance for firms on their consumer duty. And this guidance sets out the standard of care that firms should give to their customers in retail financial markets. And thereby it sets out the Financial Conduct Authority's expectations for firms when complying with their duty. So essentially, the handbook sets out or provides duties that requires the firms to act in a way that will deliver good outcomes for the retail customers. They must act in good faith towards their customers, and avoid causing them foreseeable harm, and enable and support their customers to pursue their financial objectives. it is also a duty to consider their diverse needs of their customers. The handbook also introduces new rules and guidances that will, in respect of products and services, consumers' understanding and consumer supports. And all of these rules and guidances, I think, are quite comforting for us as within the South African market, because they do in a way align to our existing obligations for FSPs, but also in when considering the COFI bill and the principles and the guidelines that the COFI bill will be introducing in our market, these also align to those that are set out therein. For example, the products and services must be designed to meet the client's needs, the characteristics and objectives of the target market in which the clients are. The financial institution or the firms must be able to communicate to ensure that the consumer understands the financial product or the services being provided to them, and that they are appropriately informed. And they must also ensure that the services provided by the financial institution or firms in the case of the UK must be able to meet the consumer's needs throughout the life of the product and the services being provided. So this is a rather comforting aspect, I think, because in a way we are trying to, or we have taken steps to align ourselves with what is market practice in the UK. Also recently in February this year, the Financial Conduct Authority issued letters to the certain market players in the financial sector in the UK, just to remind them that the duty in the handbook is a top priority, and importantly, this duty will come into force for existing products or services at the end of July and this year, whereas for closed products or services, it will come into force next year, 2024. So there is rather an aspect of, immediacy or importancy in this regard. And now I think we'll be looking at the EU jurisdiction, and I'll hand over to Jess.
Thanks, Talia. And perhaps just one other point to make on the handbook that Talia has been describing in the UK and the developments around the consumer duty is that what's interesting, I think, is that as Talia has said, the consumer duty is quite similar to and quite closely comparable to the TCF, or the Treating Customers Fairly outcomes that the Financial Sector Conduct Authority in South Africa has been driving for some time as part of the developments, the regulatory developments that we've been seeing in our jurisdiction and in our context. And so if we accept the consumer duty and the TCF, let's call it the TCF duty in South Africa, as being comparable, and we see developments in the UK to link sustainability to and sustainability advice for customers within the consumer duty owed by financial providers or firms in the UK to their clients or their customers, then we can see that as an indicator that TCF will require similarly of financial services providers in South Africa to be able to assist their clients in the same way, with the same enhanced ability to understand the products which have been specifically designed to meet a specific need, and to ensure that those products, now thinking about it from a product house perspective, that those products perform as those products are advertised to do. And if we understand that as including an obligation to, for example, where going back to Alex's point she was making a short while ago, where a product is labeled a certain way or described a certain way or sold in a certain way as having certain features or characteristics to a customer, there is obviously, one can read in the obligation to ensure that that product in fact has those features, in fact performs that way, and continues to perform that way over the life cycle of the product. That's very much the same as the TCF obligations that already exist in South African law in certain respects, and will be extended when COFI is finally an act, as Talia says, and no longer a bill. If we look at the European example, again, we can see perhaps even one step further. So there have recently, or at least in April 2021, been amendments to MiFID II. And MiFID is the Markets in Financial Instruments Directive, and it has been specifically amended by the 6 amending delegated acts, and this is part of the EU's action plan in order to ensure that the EU, particularly the financial services sector, is regulated and pushed through regulation towards a more sustainable, towards achieving more sustainable outcomes when allocating capital. And these amendments that came through to MiFID II are a very important signal from the EU that they really see sustainable finance as fulfilling a very important role in helping the world globally to meet the various challenges that are faced in respect of all of the environmental objectives, climate change being just one of them, biodiversity loss, water scarcity, the need for a circular economy, the need for better waste management, all of those important environmental objectives that need to be met in the environmental world. Sustainable finance, or the financial services sector, has an important role to play in addressing those challenges. And these amendments pursuant to these delegated acts to MiFID really signal that from the European Union, that they see that this role that sustainable finance must play. And what the most important one really for this discussion is the amendment that relates to investment advice. It affects insurance advice as well, but we're talking particularly around financial advice today. And that is to require an advisor, financial advisor, who is assessing a client's suitability for an investment to discuss with that client their sustainability preferences. So this is an important positive obligation placed on advisors in the European jurisdiction to actually have that discussion with their customers, whether the customer has initiated that discussion or not. And that is based on an idea that, and that we've been talking about today, around the fact that sustainability preferences could affect or almost certainly would affect the long-term financial performance of a particular investment. And therefore it is part of the needs analysis or the investment analysis undertaken by an advisor seeking to give wholesome or fulsome advice to their clients, taking into account all factors. Also, the amending delegated acts clarified the obligation on a financial firm when assessing its own sustainability risks, that there is an obligation on a financial firm to do so. That's perhaps less relevant for financial advisors, but it again follows all of the developments we've seen in this space, whereby there is an effort being made by regulators and policymakers to require, whether it be financial firms or corporates generally, to take these factors into account in considering their own business case. And we've seen that in South Africa as well, with the sustainability disclosure guidance being published by the JSE, which again is not mandatory, but is encouraged for listed companies, and in fact encouraged by the JSE for all companies, that these factors be considered as part of ensuring resilient, sustainable companies going forward. So looking essentially at this assessment of suitability and appropriateness within the provision of financial advice that I was referencing is the main takeaway here from the MiFID amendments, is that advisors, when providing investment advice, and again, this applies to portfolio management too, but looking at investment advice for purposes of this discussion. So when providing investment advice, firms must obtain client information to be able to recommend the investment services and financial instruments that are suitable for the client. So that's essentially the same as the needs analysis that we currently have in a South African context. But when providing the investment services, and when providing investment services more generally, so not necessarily just advice, or other than an over and above advice, the firms must ask the client to provide information regarding their knowledge and experience in the investment field, relevant to the specific type of product or service offered. Again, not that different, similar to this assessment of what is the position of the client, or the customer, what is the risk profile of the customer, what is the customer trying to achieve through their investment, what's the goal that the customer is trying to meet by making the investment. And to the extent that that goal, for example, is a long-term goal, a younger person saving for retirement in 2 or 3 decades time, then the advice that is given must be suitable given that time horizon, the risk profile, and the sustainability preferences of that customer. So what does this mean? What does this assessment of suitability mean for advisors in that jurisdiction? Because of course we can take some lessons from that and try to forward plan to the extent that we may see similar regulatory changes in our jurisdiction. Of course, it means a cost burden. There is a need in that jurisdiction, and similarly there would be one in ours, to ensure that existing procedural and organization arrangements are updated to drive and document and record this sustainability discussion with financial customers. There need to be processes to collect the sustainability preference from clients. And of course, there needs to be an ability for advisors in that jurisdiction to unlock the data that they would need to be able to advise their clients appropriately, and an ability to understand the products on offer. And that again goes back to the drive in the European jurisdiction, at least through SFDR, to have the labels be standardized. So whether a fund is an Article 8 or an Article 9 fund would mean the same thing, allowing advisors, or does mean the same thing, allowing advisors to compare different options together when giving advice to clients, which takes into account the sustainability preferences of that client. It also means that advisors need education. The investment products are complex and there is a high risk of greenwashing, as Talia has mentioned. It's difficult for consumers to understand, to really compare apples with apples. And so there is a need for the advisor to be appropriately educated and have the capacity to have those discussions with customers and to try and cut through the complexity. But at the same time, keeping the advisory process simple, so not overwhelming clients with information that they're not interested in or that's too difficult for them to understand. So that's essentially the development in Europe. And ESMA, which is the markets regulator in Europe, has acknowledged that at the moment in Europe now, given the inability to have complete data coming out of the different funds that are available, it's very difficult for advisors to live up to this requirement. And the most that could be expected of advisors in the current context in that jurisdiction is a best efforts attempt to give customers appropriate information and to give customers not too much information so that it becomes more confusing for them. Overarching rule, as from the regulator to firms operating in Europe, is that what firms should be striving for is to ensure that they put forward what's best for their clients and that they put forward options that drive value for clients, but in the context of the sustainability preferences of those clients. Now, if we take that European example and we think about what that could mean for us in South Africa. So as Talia has described earlier, when looking at the phase obligations currently applicable to financial services providers, and also looking a little bit forward to what COFI is going to bring. So we can see that there is no hard-coded obligation in South African law for advisors to advise on ESG or to ask about the sustainability preferences of their customers. But there is an obligation on advisors to provide advice with due care, skill, and diligence, to provide advice which is appropriate. There is also an obligation, and this obligation will be brought in more widely through COFI, pertaining to more product suppliers, an obligation on product suppliers to ensure that their distribution channels, so those distributing their products, which would include financial advisors, have all of the information necessary to describe and explain that product to a financial customer, particularly where that financial product has been targeted to a specific financial customer. Now, if we take that and we think about that in the context of ESG funds and sustainability investments, if a particular product house were to put out an ESG fund targeted at a certain segment of financial customer, it would be incumbent on that product house to ensure that the advisors who are advising clients on that product understand the product fully, not just the fees and costs associated with the product, the risk and reward profile of the product, the potential for financial return of the product, but also the way in which ESG factors, as we calling them using the umbrella term again, are integrated into that decision-making process. And for example, if the to what percentage of the particular makeup of the fund is driven by those ESG factors, or whether they are just taken into account, but the investment allocation in the fund is not necessarily driven by those ESG factors. All of that information would need to be given to financial advisors to enable financial advisors to be in a position to actually have that discussion with their customers. So as yet, no hard law in the South African context, although there is perhaps the framework for hard law to be developed. And given how closely our TCF obligations, treating customers fairly obligations, align with the consumer duty in the UK, we could expect to see, as that consumer duty develops in this direction, we could expect to see comparable development in our own jurisdiction. COFI, once it becomes an act, will again change the playing field somewhat. And COFI, of course, is one of the main principles of COFI is to bring through the TCF outcomes and to strengthen that from a conduct regulation perspective, to allow the FSCA as our conduct regulator to impose principles and obligations on financial services providers to ensure that they are meeting the TCF outcomes, including selling products to customers that perform as they are expected to perform and that are targeted and marketed appropriately and with sufficient information around the product, including liability on product suppliers to ensure that their distribution channel is appropriately upskilled and has enough information and knowledge around the product to be able to advise on it correctly. So we can watch this space. I think it is a developing area, and as we've said, the developments, at least in other jurisdictions that we're keeping an eye on, are happening very quickly. As it is a developing area, it's a bit of a 2 steps forward, 1 step back situation, and so it won't be perfect. Momentum is perhaps sometimes more important than perfection, and so there will be teething problems and difficulties, as we are seeing in, going back to my slide of the headlines, as we're seeing already in the funds labeling space in the European Union, where the application of SFDR has actually led to a lot of funds previously labeled as ESG funds being stripped of that label. That is because as the regulation develops, more granular detail is acquired, rules can be applied more specifically. So we must watch this space, and as financial services providers and for ourselves as advisors to financial services providers, it's certainly important to watch the international developments as an indicator of the developments that we may see in South Africa in the coming times. So thank you very much for joining us on that discussion today and for being part of the first in the CPD webinar series or masterclass series for this year. I encourage you all again to sign up for any of our upcoming masterclasses. We have some really excellent experts from different practice disciplines within the firm talking about some issues from a multi-jurisdictional perspective and also from a multidisciplinary perspective, and we should have some very interesting panel discussions as well. So please do look at the list and sign up for any that you think are important to you. That then leaves me to thank Talia and Alex very much for joining me today in this discussion as we start exploring what changes we could be seeing in our regulatory environment and how those could be developed or influenced by changes abroad. So thank you very much, Talia and Alex, for joining me. Thank you everybody else for being part of the discussion today. If you have loaded your question in the Q&A block and we haven't been able to address it through this presentation, then we will be contacting you after this presentation to pick that up with you. And finally, if you are needing a CPD certificate to confirm your attendance at this webinar, then that will come through to you afterwards. Of course, once we've been able to verify that you have been online for the duration of the webinar. So look out for a thank you email from us, which will assist you in that regard. We will also share our slides with you, and this recording will also be available for you to watch again or to share with anyone else who you think may be interested. So thank you, and we hope to see you on one of our masterclasses coming up.